A guy named Marcus in Austin, Texas pays $600 every single year for Microsoft Office. He bought the lifetime license 8 years ago. He still has it. He pays anyway. Marcus is worth $4.2 million. He did not make a mistake on his credit card statement. He does this on purpose. And when you find out why, you are going to feel genuinely angry that nobody taught you this earlier. This is not about software. It is about a financial behavior that separates people who accumulate wealth quietly from people who stay exactly where they are. The gap between those two groups is not income. It is not education. It is how they treat the concept of duplication. Here is what Marcus is actually doing. He pays for Microsoft 365 every year even though he owns Office 2016 outright. But that $600 is not a subscription expense on his personal budget. It runs through one of his LLCs as a business operating cost. That means it is deductible. The actual out-of-pocket cost after his tax bracket is applied? Around $360. But that is still money out the door, right? So why did? Because Marcus does not stop there. He has 3 separate business entities. Each one runs its own Microsoft 365 subscription. Each one deducts it. But here is the part that actually matters. Each subscription comes with 1 terabyte of cloud storage, full legal licensing for up to 5 users, and documented proof of enterprise-grade software use. That last piece sounds boring. It is not. When Marcus applied for a business line of credit last year, his underwriter reviewed his operating expenses. Recurring software subscriptions signal something specific to lenders. They signal that a business is active, structured, and operated with professional infrastructure. A one-time purchase from 8 years ago signals nothing. It does not show up as a recurring cost. It does not demonstrate ongoing operational commitment. Marcus paid $600 and used it to help secure a $250,000 credit line at a favorable rate. That is the license duplication strategy. You pay for something you technically already own, but you run it through a structure that transforms a consumer expense into a business asset that talks to lenders, talks to the IRS, and talks to anyone who audits whether your entity is real. If that surprised you, subscribe right now. We cover exactly this kind of thing. The financial behavior that is completely legal, completely documented, and completely invisible unless someone shows it to you. Now here is the second layer. And this is where it gets more interesting. Marcus is not just buying Microsoft 365. He is buying recurring proof of life for his business entities. The IRS has a concept called hobby loss rules. If your business does not look like a real business, they can reclassify your deductions. One of the clearest ways to demonstrate legitimacy is consistent, documented operating expenses. A pattern of monthly software subscriptions across multiple years builds what tax attorneys call an operational footprint. It is evidence that your LLC exists for commerce, not just for deductions. $360 a year in real cost, fully documented, creates a paper trail that protects potentially tens of thousands in deductions across your entity structure. The math is not even close. But there is a third piece most people miss entirely. When you duplicate a software license across multiple LLCs, you are also creating user accounts, admin credentials, and separate data environments for each entity. That separation matters legally. It is called corporate veil integrity. If one entity ever faces a lawsuit or liability claim, the court looks at whether your businesses are truly separate. Shared software logins, shared storage, shared accounts? That is evidence of commingling. Separate subscriptions with separate admin accounts? That is evidence of genuine separation. Marcus is not paying $600 for software. He is paying $600 for legal insulation between his businesses. So what can you actually do with this? You do not need to be worth $4 million. You need one legitimate business entity. Even a single-member LLC with a side income qualifies. Once you have that, look at every software tool you use personally. Adobe, Notion, QuickBooks, Microsoft, Google Workspace. Now ask 2 questions. 1. Is there a business version of this subscription? 2. Is there a legitimate business reason for me to run this through my entity? If yes to both, you have a deductible expense. If you have multiple entities, you may have a reason to run separate subscriptions for each one. Not to waste money. To document, to protect, and to signal solvency to lenders and the IRS at the same time. The people who understand this are not smarter than you. They just had access to a conversation you were never invited into. The CPA who works for wealthy clients explains this over lunch. Your H&R Block appointment does not cover it. Start with one entity. Get one real subscription running through it. Document the business purpose in writing. Do that consistently for 12 months and you have the beginning of an operational footprint. That is how Marcus started. He had one LLC and one subscription. Now he has 3 entities, documented infrastructure, and a credit line that most people with his same income could never access. The software was never the point. The structure was always the point. Do not leave this video yet. The next thing we cover is why high net worth individuals intentionally create small, recurring losses in certain LLCs and how that loss is worth more to them than profit would be. If that sounds backwards, it is. And it is completely real. Stay right here.